Most people assume that the moment someone with life insurance dies, their family gets paid right away. That's not how it works. Some claims clear in days, others drag on for months, and some do get denied completely. The difference usually comes down to a few things. Most families never find out about until it's too late. I'll show you what actually controls the timeline. My name is Joel from Insurance Wise. Let's get into it. Life insurance companies usually don't automatically know when a policyholder passes away. A beneficiary, typically a spouse, child, relative, or business partner, must contact the insurer and submit a claim. They will normally need a completed claim form, a certified copy of the death certificate, some ID, and the policyholder's information. If the beneficiary doesn't know which company issued the policy, they might need to search financial records, contact the policyholder's employer or financial advisor, or use a policy locator service. Once the company receives the claim, it confirms that the policy was active, it verifies the cause and date of death, and confirms that the person filing the claim is the correct beneficiary. If everything is straightforward, the claim can move relatively pretty quick. So most uncomplicated life insurance claims are paid within approximately 2 to 6 weeks after the insurer receives all required documentation. Some companies may process a simple claim within a few business days. Others might take closer to 30 or 60 days. The important detail is that the timeline usually begins once the insurer has received everything it needs, not necessarily on the date that the person passes away. So it can take time for the family to obtain a certified death certificate, locate the policy, contact the insurer, and complete the forms. And state laws might also establish processing requirements or require insurers to pay interest when a benefit remains unpaid beyond a certain period. But there is no single payment deadline that applies to every claim. One of the most common causes of a delay is incomplete or incorrect paperwork. Even a small issue such as a misspelled name or information that doesn't match the policy may require additional verification. An outdated beneficiary can also create problems. If the named beneficiary has already passed away, they cannot be located, or the policyholder never selected one, the benefit might be paid to the policyholder's estate. That could send the money through probate, which might take months or potentially longer. Problems can also occur when multiple people believe they are entitled to the benefit. This may happen after a divorce, remarriage, or when a beneficiary was changed shortly before the policyholder's death. The type of death can also affect the timeline. If the death is still being investigated, the insurer may wait for an official report. This can happen following an accident, homicide, suspicious death, or when the official cause of death hasn't been determined. One of the most important life insurance rules is the contestability period. For most policies, this lasts for the first 2 years after coverage begins. If the insured person passes away during this period, the insurance company may investigate the original application more closely and may review medical records, prescription history, financial information, and other documents to confirm that the application was actually accurate. This doesn't mean the claim will automatically be denied. It just simply means the insurance company may examine just a little bit more carefully, which can extend the payment timeline. This doesn't mean the claim will automatically be denied. However, if the insurer discovers an important misrepresentation such as an undisclosed tobacco use, serious medical diagnosis, or a dangerous occupation, it could just or deny the benefit depending on the circumstances and applicable to the law. That's why every application question should be answered truthfully. Saving money by leaving out important information could put your family's entire payout at risk. Now, most policies also include a suicide exclusion that generally applies during the first 2 years of the coverage, although the exact period may vary by state. If the insured person dies by suicide, during that exclusion period, the company may not pay the full death benefit. Instead, it will typically refund the premiums that were paid after the exclusion period ends. Suicide might be covered under the policy, but because the rules and policy language can vary, beneficiaries should still submit a claim and allow the insurance company to make the official determination. Can a life insurance claim be denied? Yes. Absolutely, a life insurance claim could be denied, but the insurer should have a valid contractual or legal reason. Common reasons include the policy expired because premiums weren't paid, the application contained a material misrepresentation, or the death fell under a policy exclusion, or the claimant wasn't the valid beneficiary. A claim can also become complicated if the beneficiary is suspected of intentionally causing the policyholder's death under what are commonly called slayer laws. Someone generally cannot financially benefit from intentionally killing the insured person. Beneficiaries should also understand the difference between a delayed claim and a denied claim. A delay means the insurer is still reviewing the case or waiting for more information. A denial means the company has decided that the benefit isn't payable. If a claim is denied, the insurer should provide an explanation in writing, and the beneficiary may be able to appeal, contact their state insurance department, or consult an attorney. So let's get into how is the money paid. So most beneficiaries choose a lump sum payment, meaning they receive the entire death benefit at once. However, insurance companies may offer other options, including installments, payments over a fixed number of years, an annuity, or an interest-bearing account. A lump sum is often the simplest option, but it isn't automatically the best choice for everyone. Beneficiaries should consider immediate bills, outstanding debts, long-term expenses, and whether they're comfortable managing a large amount of money. Life insurance proceeds paid directly to an individual beneficiary are generally not subject to federal income tax. However, interest earned on the benefit may be taxable. Estate taxes or other complications may also apply in certain situations, so professional guidance might be helpful for a large payout. Now, there's several things you can do to prevent delays. First, review your beneficiaries regularly, especially after marriage, divorce, the birth of a child, or the death of a beneficiary. Second, tell your family that the policy exists. Millions of dollars in benefits can go unclaimed because family members don't even know the coverage was purchased. And keep the insurance name, policy number, and the contact information somewhere safe but accessible. And third, make sure your premiums are paid and confirm that the policy remains active. And name a backup beneficiary in case your premium one passes away before you. And finally, provide complete, accurate information when applying for coverage. These simple steps can make an enormous difference for your whole family during an already difficult time. How quickly do family receives a payout for the life insurance? A straightforward claim with complete documents will often be paid within 2 to 6 weeks. However, investigations, paperwork problems, beneficiary disputes, policy exclusions, or death during the contestability period can make the process take a little bit longer. So if you're looking for some life insurance options or want to compare your available options, visit money.com and I'll put the link down in the description below. That way you can compare your policies and they'll help you find the best coverage that fits your family's needs and budget. Subscribe to Insurance Wise for more clear and practical insurance breakdowns. This is Joel and I'll see you in the next video.